Market Blaster, where we blow apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets Editor John Dobis, joined in the task of explaining the markets today by John Buckingham. John's a value manager from California, SoCal, big Vikings fan. That's not really apropos of anything necessarily, but the Vikings are good from time to time. But you're good quite frequently, John. Your letter is a prudent speculator, president of Al Frank Asset Management and two mutual funds, VALUX and VALDX. It's a dividend fund. Thanks for coming by.
Thanks for having me.
We've been talking to John for years now. John, of course, with the Prudent Speculator, Forbes does offer it as a newsletter. We're not trying to brag about anything here, just trying to point out the obvious, that since 1991, your model portfolio has had a return of 17.2% annualized. That's tracked by Mark Holbert. Stocks overall, the Wilshire 5000, at least in the US, up 8.2% annualized. So you've got a margin of outperformance here of about 100%. Not bad. Very nice.
Thank you.
What are your big areas that you had a lot of fun with and made a lot of money for your clients with in the last decade? Housing, and housing's coming back, but we'll get to that in a second. Overall, here's the Russell 3000 Value Index since 2000, and here's the Russell Growth Index. We'll talk about the distinction between growth and value, but as you can see, value is up 65% cumulatively in the past decade or so. Growth down 10%. John, you think of growth stocks being like the Apples of the world and things like that grow great guns. Value is boring old smokestack industries, but it really makes you some money. How do you account for this outperformance?
Well, historically, value has outperformed growth over the long term by a wide margin. If you go back to the turn of the millennium, we had tech stocks and the go-go years, the internet stocks, the growthier stocks had appreciated significantly and were very expensive at starting that period. So value was relatively attractive, and people talk about the lost decade of the 2000s. Well, there wasn't a lost decade for value investors. There was a lost decade for index fund investors, but not for value.
And you had energy, of course, in the value.
Sure.
And energy surged in the past decade. This thing surged in the past decade. You, back in '02, talking about Apple's cash-rich balance sheet, great brand equity, and possibly great future under this new guy who came back to the company, Steve Jobs.
Right. Well, Apple was a classic value stock in our view back then because it did trade at a very inexpensive multiple of sales. The balance sheet was fantastic with lots of cash, just as it is today. But back then, you didn't have to pay nearly $500 a share for it.
What did it need? It needed a catalyst, right?
Well, it needed a catalyst. Obviously, every company needs to have that. And Apple had a history of innovative products. And so, believe it or not, back in 2002, there was a little device called the iPod, which I like to say was just a twinkle in Steve Jobs' eye. And it wasn't really anything that they had tremendous hopes, at least externally. They didn't say that they had a lot of hope.
So when you look at situations like that, where the balance sheet is pristine and the company's got a good history, you're looking for the other part of the trio, which is a good catalyst to keep it going, to get it going again?
Well, you certainly are, but sometimes you just let nature take its course, and that's the beauty of having value stocks. You buy undervalued and you have the patience to stay with them, and often the good things happen, and when the good things happen, you can get an Apple computer. Whereas a growth stock can go the other way if a bad thing happens to them.
Apple's knocking on $500 right now. You still like an Apple?
Well, we like its performance, of course, because we still own it, but we're not really at this price ready to buy it again.
Only 11 times earnings. I mean, come on.
Well, that's the interesting thing is that Apple's earnings have been so sensational over the years that it is actually, by certain criteria, a
P/E ratio, it's a cheap stock.
And they still have a fantastic balance sheet now with over $90 a share in cash. So Apple, you can make a value argument for it. I just think there are other stocks.
It's up there in price for sure. It's a nosebleed on the price tag, but it's still a good cheap stock. Housing, we're seeing some signs of a rebound. The XHB is up about 100% from October. This is crazy. You like a stock called MDC Holdings. They're a home builder?
Right, exactly. Single-family home builder across the country. They build houses, so geographically diverse. The reason we like MDC is that balance sheet theme we talked about with Apple. MDC is one of the best capitalized builders out there, and they also reward us with a big fat dividend. So right now the yield's about 4%, had been 5% as the stock price has
Stock's on the move here. It went from 21 to almost $25 just in the past week, really, right here. So
yes.
Looking good.
Yeah. So I think housing is something you want to play, and primarily because I think we're kind of treading along the bottom here.
Usually you're not drawn in by something like that, are you? You don't care about the stock chart too much.
No, we're not chartists by any stretch of the imagination, but housing has certainly ticked up here, and so as I look at some of these stocks, they've had some monster runs,
Right.
as you point out. So some of these, you might want to wait for a little bit of a pullback.
Here's the XHB, $12 in October, and it's $20 now. This is the ETF that holds all of the home builders, or at least quite a few of them. So nice little run there. A little conceptual art here. It's not Edvard Munch. It's actually a Whirlpool. You like Whirlpool along the lines of the housing recovery. New houses need new washing machines.
Well, they do. Plus, Whirlpool is a big international provider of appliances in South America, a big market for them in Central America. So Whirlpool is another stock that has been beaten up significantly, has performed
quite a screamer here in 2012, up from below $50 to about $70 right now.
Yeah, and you had a single-digit PE there. You have a yield still of about 3%. The PE is still a single digit even after the big rally. So I think Whirlpool is a name that you can still look to buy.
You're still swimming in it. Okay. Home Depot, obviously, this was linked with the housing boom all throughout the 2000s. Stock now is achieved interim new high, $45, and it's held it for the past 3-4 weeks. Stock was down around $28 right after the downgrade here in the summertime. Home Depot, people buying that many shovels that it's going to go up that much, John?
Well, it's an interesting name that's performed really, really well, and frankly, it didn't get beat up as much as many of the other housing-related stocks. So, in our shop, we're looking at Home Depot and saying, this might be a name that we want to think about taking, ringing the register, if you will, taking our profits on. But we are still holding it today. If you're looking for an investment in this space, though, I'd probably be looking for Whirlpool first, and then an MDC before a Home Depot. But I am still willing to hold on to Home Depot.
Some basic industries here. You're talking about steel making. NUE, symbol for Nucor, a company down in Charlotte, North Carolina, the first mini mill in the US of A. No ennui in NUE. You like the French play on words there? Anyway, John, very little boring about a run from $32 to $44.
Well, we like Nucor primarily because it has a relatively stable earnings stream. They don't have the booms and busts that some of the other players have, and obviously the cost structure is far different in the mini mill business. And more importantly, these days we really like dividend payers. Nucor has consistently paid a very generous dividend. I think you've got, in this case, an inexpensive stock still with an attractive yield in a sector that I think has some legs here as the global economy starts to show
manufacturing numbers have been great in the U.S. Auto numbers have been great. Both of those things augur well for steel. We're looking here at Tiffany for no real reason. But in any case, John, thanks for coming by. Any other sectors or areas of opportunity? How about overseas stocks? Do you see value over there?
Well, I'm a contrarian, and so what's performed miserably is often what I like to look at. So if you look at European stocks, I think that's an area investors should be focusing on.
Looking
There's
at
lots
Europe?
of value there.
IEV is an exchange-traded fund that lets you play the entire Europe 350 index. Maybe a large cap thing like that would work out well. He's John Buckingham. Thanks for coming in again. I'm John Dobus from Market Blaster.